Hello, everyone. Welcome to our presentation. As you all know, financial markets play an important role in the construction and development of any countries. Seeing the importance of financial markets, this report will discuss the debt securities or equity security and their effect on the development of the country, its debt expansion, and growth in national income. Now, take some introduction. So what is financial market? A financial market is a market where the trading of security occurs, including the stock market, the bond market, the forex market, and derivative market, among others. And there are three functions of the financial market. The first is channeling funds. The second is encouraging saving and investment. And the last is raising the financial assets liquidity. So what is debt security? Debt security refers to a financial instrument that contain a commitment from the issuers to pay the holder a certain amount by a specific date. And the most common form of such security is bonds. And that security provide regular payment of interest and ensure repayment of principal. They can be sold prior to maturity date to allow investor to know that they are gain or lose from their initial investment. Now, equity security. How about equity security? So now we come to the next bond. It is a share of capital stock that reflect the shareholders' ownership stake in your business, partnership, or trust. Share of capital stock include both common and preferred stock. Equity security are only issued by firm. And now we come to the effect of each market on every country's economy. It's true that countries that lack or absence of efficient financial market prove to be a barrier to economic development that limit expansion activities and income growth for the following reason. The first is will affect to the development of the country, of course, because a well-developed debt market provides essential benefit to the economy. It provides a yield curve, a market that determines term structure of interest rate. The yield curve is used as a standard for pricing credit risk, bank loans, or equity. Because bond intermediation costs are lower than bank financing, so it might cut the funding cost for best quality borrower and to help that market create competition with the banking sector, perhaps reducing the dominance of bank in providing corporate financing. And it also allows the transfer of risk via securitization for banks. The exposure to liquidity risk is reduced and their maturity mismatch is mitigated. The banking system would be larger if in the absence of a debt market than it would be. So the presence of a domestic debt market can have to transfer a risk outside of the banking system, allowing the government to take a step back. And the domestic bond market and banking system coexisting allow one serve as a backup for the other. That market make financing intermediation more efficient because they utilize market mechanisms to allocate the free credit. That market in particular are expected to facilitate availability of long-term funds for specific purposes such as for infrastructure, etc. This will bring more transparency in the process of credit allocation. Debt market can aid the development of the derivative market, etc. So let's move on to equity security. Stock market fluctuation may have profound acute economic impact on the economy and individual customer. A drop in stock price has the potential to disrupt the economy at large scale. With stock price rising, the investor and consumer have greater money and optimism about future prospects. This improves confidence, leads to the higher spending, and the result leads to increased sales and earning for a corporation. Further, it's boosting the GDP. In fact, it's clear how important the stock market is for the economy because it's allows funds to be transferred from those who owe them but have no investment opportunity to those who enjoy this opportunity. By utilizing the stock market function to increase production, achieve economic efficiency, and improve the level of prosperity in society. The liquidity of market can have an impact on economic activity. And many high return projects require a long-run commitment of capital. Yes, and the health of the financial market also impact on the business expansion. The businesses rely on financial market to expand, especially small and medium-sized enterprises. They won't be able to raise funds to expand if they cannot issue debt or equity securities. The stock market movement can have an influence on companies in a variety of ways. As a result, the company with high market value can attract more investors. As a retail investor, they have limited capital, but they make investment in a small volume of the equity and debt security. And how about effect on growth in national income? So what is national income? It means the value of goods and services produced by a country during a financial year. And with the impact of debt and equity market, business and entities in an economy provide employment opportunity. And the next impact is they display in investor confidence. Investor confidence in equity results in increased buying activity. When consumers buy more, business sell those goods and services, choose to produce more and sell more. As a result, the national income rises. Furthermore, the financial market had to reduce poverty and inequality. Finally, the well-established financial market will create favorable conditions for the implementation of the government's economic reform and opening up policy. Now, we will take an example about the impact of debt and equity security on one country. This is an example on the stock market of Vietnam. Since 2006, the stock market in Vietnam has grown and it has seen numerous major swings since then. However, the stability and health of the market has never been appreciated when there are always strange and illegal variation. Moreover, the stock market, instead of being a safe investment channel, it gradually became a gambling game with the manipulation of the, you say it like shark. And the most recent example is the event that the FLC chairman Trịnh Văn Quyết were arrested for manipulating securities. This case clearly shows the nature of a non-transparent and risky stock market, with some famous factors, such as the act of illegal selling stock to influence and manipulate the market for personal advantage, are becoming more and more sophisticated. And as the current state of the market is still flooded and disclosure violation, insider trading, and financial reporting misrepresentation. Investors who lack knowledge easily lead to herd trading. And the last but not least, the administration of the trade committee is still insufficient, resulting in numerous loopholes and should deterioration of corporate ethics. Stock market manipulation action, particularly insider trading, have caused countless loss to the stock market of Vietnam, including loss of investors' confidence. Because of the negative impact of the market liquidity and high transaction costs, many investors are hesitant to invest, and the expected level of the Vietnamese stock market of the global financial map has dropped significantly. The loss of investor confidence in stock market, business have to pay more for the insurance of the security and thereby limiting resource for producing and business expansion. When it comes to investing in Vietnam, foreign investors are being more cautious, cutting down the country's opportunity for investment, collaboration, and growth. And take the lesson from Vietnam, we can conclude that an equity market play a vital role in any country's economy. Therefore, the government in each country needs to have appropriate policies and solutions to be a strong, stable, and developed financial market so that the financial market can play its full role in helping the economy grow consistently, especially during the period integration into the world's economy. And this is the end of our presentation. Thank you.